And this is Bloomberg Technology. Coming up, Sprint is tapping superstar investors Warren Buffett and John Malone for billions of dollars. Will the move help turn around the struggling telecom giant? We will discuss. Plus, investor revolt at Uber continues. Some of the first backers of the ride-hailing app are now looking to sell their shares. And with just a few days until Game of Thrones returns, we're taking a closer look at HBO's standalone streaming service and how it stacks up to the competition. First to the lead, the latest twist in the Uber saga. Bloomberg has learned that Uber shareholders and its board, led by early backer Benchmark, have discussed selling some of their shares to SoftBank and other potential investors. The deal could include an injection of new money into the ride-hailing startup, according to people familiar with the matter. It's unclear what valuation the shares would carry or how much SoftBank or other investors would buy. Any private share sale like this would need to be approved by Uber's board. For more on this story, we're joined by Bloomberg Tech's Peter Elstrom, our editor-at-large Corey Johnson, and our startup reporter Eric Newcomer, who broke the story and covers Uber. How exactly will this work?
Yeah, the story is literally developing, but Benchmark talked about this with SoftBank, I think, pre the resignation of Travis, and so it has been discussed for a while. That happened last month.
And Travis has, for many years, been opposed to
very restrictive, especially of investor share sales. And now there's talks that include the board and shareholders about whether to sell to SoftBank or someone else. A sort of probably combined primary and secondary, meaning they get some new money and then investors get to get some cash for their investment.
Months ago, 3 months ago, 4 months ago, Corey, Uber shares were the most coveted shares out there. What do you make of this now?
Well, if you're a Benchmark or somebody else who's sitting on this thing that could be one of the greatest investment gains of your whole freaking life, and yet you've got the CFO is gone, the COO is gone, the CEO is gone, that this thing could be careening in a way without leadership, it'd be very disconcerting. You'd certainly want to take some money off the table. You can imagine them clamoring to, they're sitting on this unrealized gain that could be in the thousands of percents. They surely would be very happy to take only 1,000% or only 500% or whatever the gain is. You can imagine that they'd want to get some of that money out and not have to wait for an IPO.
Now, Peter, you cover SoftBank. Obviously, they've got a lot of money, $93 billion, to put to work, but are they just going to be vacuuming up everyone else's leftovers?
Well, this kind of deal would certainly be a surprise. SoftBank has been a big backer of competing ride-hailing services, including Didi in China, Ola in India, and also Grab in Southeast Asia. So if they're also going to put money into Uber, that would be a bit of a surprise. They had been backing what looked like an anti-Uber alliance before this, but Masayoshi Son is the deal maker who never sleeps. He continues to press for deals. He made the largest investment ever in Didi, and so Uber. It sounds like he's interested in Uber too.
What do you imagine, Eric, that Travis Kalanick is thinking right now? He's still on the board.
Yeah.
He's still the biggest shareholder.
Right. I mean, I think he was sort of caught out of the loop on this. I put that in the story. So there's this question of what he thinks now. I mean, we are getting to a moment, I think, to Peter's point on SoftBank, where Uber is competing less directly with some of SoftBank's investments and with some of its competitors. I mean, they cut a deal with Didi. So I think there's a hope.
Didi deal with the Russian
Yandex
too.
So I mean, that's not SoftBank, but the idea, there's sort of a pathway to sort of, okay, they're going to be local market players, and SoftBank has covered so many of these investments. At the same time, it could be somebody else. Like, they've talked to SoftBank. There are definitely other investors in the mix. I haven't figured out who they are. I'm trying to figure out who they are, but
It's okay if they call you?
Yes, please do.
What's your take, Corey?
Well, you could certainly be invested in the number one and the number two, or the number one and the number three. The fact that they're invested in a couple of these companies doesn't mean they have to pick the winner. In fact, the venture capital approach would be to spread the bet, to diversify those bets. If they like the sector and they see the growth, I loved seeing those numbers from Yandex yesterday, what little they had in that slide presentation, because it really let us see how big the business is just in Russia and countries around there. So many of these countries are seeing these businesses grow so fast. You can imagine that any investor who's seen the numbers is going to say, I want to get a piece of that anywhere I can get it.
So, Peter, another big story breaking today that SoftBank and Masa has reached out to Warren Buffett and John Malone to invest $10 to $20 billion in Sprint. What can you tell us?
Right. Yeah. Does this make sense? Well, certainly SoftBank has been looking for a way out of the Sprint investment. They've been in talks with a number of different partners, including T-Mobile in the past. Masayoshi Son tried to merge the two companies together before. Now he has held talks with Warren Buffett and John Malone, as you mentioned. He's looking for some kind of investment in the company. Sources have told us that Buffett could put in $10 to $20 billion, so an enormous investment in the company. Part of that would go for shares in the company. Part of it would just be cash that the company would be able to use to build out its network. It's not exactly clear what role John Malone would play. That could be additional money that would come into the business at this point. But Masa is really looking for some alternatives with Sprint, not just wanting to negotiate solely with T-Mobile.
Sprint shares spiked on the news. Right. T-Mobile shares also up slightly as well. What do you make of that?
Well, I mean, it's slight moves in stock. Look, Sprint's a fascinating business because they're sitting on so much unutilized spectrum. They just don't have the money to deploy. They've got about a $35 billion market cap and about $41 billion in debt. They've already borrowed so much money. Their access to capital is not as great as they would like because they want to take all that spectrum they've got and build out a network. They just don't have the cash to do it. And so, a friend in need is a friend indeed. And I'm sure they're looking at Buffett, they're looking at John Malone, they're looking at anyone who's got deep pockets and wants to fund that kind of growth.
So, Peter, talk to us about what you see as Masayoshi Son's greater game here.
Well, Sprint has been a problem for them. They thought they were going to be able to merge the two companies together. He thought he was going to be able to repeat in the United States much what he did in Japan by buying the third largest carrier and then making it into a real competitive player. He has not been able to accomplish that with Sprint, so I think he's looking for some kind of exit from the business at this point. Maybe that's a part of it now and then more of it later. But Malone and Buffett, of course, are two of the best deal makers in the country, and they are not going to provide this capital support cheaply. It will certainly come with some serious terms from Masayoshi Son. Malone made billions and billions of dollars with XM Sirius in particular, and a number of other deals. They're gonna get a pretty good deal if they do come in with this kind of capital.
What do you think this means, Corey, for a possible merger, given the political environment?
Yeah. Well, I think that's the key there, right? Is this the Federal Trade Commission and even this FCC more likely to approve this kind of a deal that looked like it was going to get rejected in Sprint T-Mobile? The indications are certainly yes, but maybe this just gives him even more cash, will give him more leverage to try to draw a better deal with T-Mobile.
All right. Corey Johnson, our editor-at-large, Peter Elstrom, our Asia Tech editor, Eric Newcomer. Expect those investors' names stat before the end of the show.
They
Thank
can call
you all
anytime.
so much. Okay. Indian software exporter Infosys raised its annual revenue forecast as newer digital services helped it gain new contracts despite shrinking client budgets. Infosys beat on the top and bottom line in its latest earnings, but quarterly profit rose just 1%. As for its ambitious plans to hire 10,000 workers in the U.S., CEO Vishal Sikka says they've already hired about 600 new employees. Long way to go. Coming up, we go across the pond for a look at London's booming fintech sector, where the largest European Series A VC is placing its bets. And Bloomberg Tech is live streaming on Twitter. Check us out at Bloomberg Tech TV, weekdays 5 p.m. in New York, 2 p.m. in San Francisco. This is Bloomberg. AT&T is dialing up organizational changes following its $85 billion acquisition of Time Warner. People familiar with the matter say Randall Stevenson will drop the CEO title he's held for 10 years and become executive chairman. He'll oversee a pair of CEOs who will independently manage the company's telecom and media businesses. Well, it has been a volatile week for Bitcoin, on track for its biggest weekly decline since March. But the frenzy to get into cryptocurrencies and new coin offerings continues and dominated discussions at FinTech Week in London. The annual conference wrapped up today. Our Caroline Hyde sat down with a key investor in the European FinTech space. Caroline, tell us what you got.
Yeah, Emily, great to see you. Thank you. And I got the chance to sit down with Rob Moffat. Now, he's partner at Balderton Capital, which owns the title of the largest Series A-focused European VC. Now, the VC firm has a bevy of fintech portfolio companies, including global money app Revolut, which announced a $66 million funding round just this week to help it expand geographically, but to also push into cryptocurrencies. Now, before delving into the world of blockchain, though, I started by asking, well, where he was finding opportunities to invest and the types of businesses catching his eye. Take a listen.
We've historically seen a lot of activity around lending, and we were early investors in Zopa, who was the first peer-to-peer lender coming out of Europe. Investors in Wonga, we were investors in a company, Prodigy Finance, in student lending, who are doing exceptionally well. So that was the first area we saw great growth. Second one was the neobanks and everything around new forms of doing digital banking. We're investors in Revolut, who announced a $66 million raise this week, and they started off doing foreign exchange for people traveling abroad, but have now broadened into the place where people go for all of their day-to-day financial needs and becoming this real hub for your financial needs. So that's been really exciting growth from 0 to 700,000 users over 2 years. It's extraordinary to see that kind of growth in financial services.
And what about the cryptocurrency spectrum in general? I mean, we've had such volatility this week alone, whether you're looking at the Ethereum price, for example. How does this continue to grow or not, as the case may be?
Our view as a VC is we're looking for how we're going to build real businesses. And I think Ethereum in particular is fascinating. There are so many different industries that could be transformed using Ethereum. The fact that you don't need to have a trusted intermediary, that you have the smart contracts that enable business, whether it's trade or it's stores of value or it's diamond trade, whatever it might be, there's a lot you can do with smart contracts. The question is, how far away is that, and how long does it take to get there, and what mechanism do you use to get there? Does it justify having 100 different altcoins out there for every single use case, or is there actually a lot that can be done with Ethereum itself? And that's what I'm trying to work out right now. I'm much less worried about the near-term volatility.
Talking of volatility, we've seen plenty of volatility in some of the recent share offerings that we've seen in the US, for example, Snap down once again today. Are you optimistic or slightly more nervous about where the exit routes go for companies such as yours?
I think the IPO market is absolutely there if you've got a good company, and you have to be able to demonstrate that. And then it's a question around where do you price the IPO. And I think Delivery Hero went out at a sort of fairly sensible level, and they're doing the classic way of doing it, which is beat and raise, and build from there. And I think Snap was more disappointing, right, in its first set of results, and maybe they went out a little bit too high. But still, a multi-billion-dollar company created from nothing in 5 years is a pretty impressive result for Snap.
Has your view on what a good company is changed, or indeed the life cycle of the good company? Because is there now pressure on portfolio companies to not just have revenue, but also to be showing that they can be profitable as well? Do you need to be more obvious about a viable business model before you can start to exit?
I think in Europe that's always been the case. I can't think of any tech IPO in Europe where the company hasn't been profitable or had a clear path to profitability, right? The unit economics stack up that it will get there. And I think in the US that's not necessarily been the case. There have been a few that have managed to get out purely on growth, but we haven't seen that here, so it's not here to lose. I think has the dynamics changed? Not really. I think speed of growth is still what people really get excited by, and a credible path to profitability.
Are there any portfolio companies that look potentially ready to IPO?
I think there's a couple of ours that are in that window, and then it's trying to get out at the right price and with the right story. We IPO'd Talend last year, and that's seen a sort of great share price performance since IPO, so that's a nice success story for us to think about for other portfolio companies.
And M&A, of course, not the only route to exit is IPO, but there's also M&A. And are we seeing deep pockets coming from larger institutions wanting to get into the startup world?
I think the SoftBank 93 billion fund is a great indication, right? The fact that that's going to be based in London is going to be very interesting to see.
You, competition?
No, because they're way out of our range, right? They want to invest minimum $500 million, and we want to invest maximum $15 million. So, no, I think it's an interesting exit route, right? You saw with them buying Arm that they are not short of ambition, right? They're willing to take out the biggest public tech company in the UK. So that is a really interesting kind of strategic investment. So I think we'll see more of that, I think, coming from China in particular. The US continues to be engaged with Europe. You're seeing Google with DeepMind and with other acquisitions. Twitter bought one of our companies, Magic Pony, last year for a sort of big sort of strategic price. So we are seeing it, but not in huge volumes, and I think perhaps more of the volume might come from Asia over the coming years.
So more Chinese and Asian money chasing European startups then. Watch this space. That was Balderton Capital partner Rob Buffett. Emily.
All right, Caroline Hyde in London. Thanks, Caroline. Coming up, Snap and Blue Apron have had a tough go since taking to the public markets. What their struggles mean for other tech IPOs on the horizon. This is Bloomberg. Call it the Amazon effect. The online retailer wasn't the only winner during its Prime Day sales. eBay also had its 2 best sales days ever for July during the Amazon event, according to a person familiar with the matter. In anticipation of Prime Day, the competing online marketplace launched an advertising blitz using the slogan, quote, "Did you check eBay?" Now, to another big story we are watching. Snap shares continue to fall after yet another analyst downgrade, adding to an already dismal trading week for the stock. Analysts at Cowen lowered their rating to market perform from outperform, cutting their price target to $17 a share from $21, blaming a lower ad sales forecast. Earlier this week, Snapchat's parent company was downgraded by Morgan Stanley, which took the company public earlier this year. The stock has plunged this week to break below its IPO price of $17 a share. So, what does this signal to the host of tech IPOs on the horizon, including Airbnb, Uber, and Dropbox? Joining us now to discuss, our Bloomberg IPO reporter, Alex Barinka in New York. So, Alex, how do you think all these other companies are perceiving this market?
One thing's for sure here, at the IPO, you've got to get the valuation right. That is one of the big takeaways from this Snap price move right now. And also, frankly, if you don't give investors any kind of forward-looking benchmarks to work off of, that could present an issue. If you remember back when Snap listed in March, the company didn't give any forward-looking guidance. Analysts basically had all of the backward numbers to work off of and create their own models. After first earnings report, you saw the stock fall off. It hasn't recovered since, and it's gone down since then. And a lot of this is just lack of conviction in the fact that Snap has things to show investors. This was always going to be kind of a prove it, show me story, because Snap's management didn't show or give a lot of information as to what incremental changes in the app will look like, as to how they're going to better show advertisers return on their investment. So you've seen the valuation come down quite a bit. And here you can see back in October, when we first reported on the size of this company, they were aiming for a valuation of as much as $40 billion. Right now, it's closer to $18 billion in about 6 months' time with that listing there in the middle. So lots of concerns here in terms of living up to that valuation. And a lot of that comes down to ad sales.
Blue Apron's also had a rough go, down 26% now since the IPO. What's happening there?
And that one took off kind of to the negative since the beginning. You'll remember that deal launched 3 days after Amazon agreed to buy Whole Foods. That has overhung this deal for sure. They did, interestingly enough, decide to go out at the $3 billion valuation that they had planned on listing at about a year ago. So when they did list in the past few weeks, you see that they had also taken a number of valuation cuts down to the current valuation. And when you do take a step back and you think about the rest of the companies in the private market pipeline who could be considering getting an exit, we've talked a lot about the kind of overheated, per se, 2014 and 2015 private market funding environment. Now we're seeing that actually materially play out with some of the biggest and buzziest names as they hit the private markets. Before these two deals, which are deals that consumers know about, you know Snapchat, you know Blue Apron, we saw a lot of enterprise tech listings. Those have gone out on average basically flat or a little bit up in terms of valuation. Now we're getting into some of these bigger deals where you saw a lot of crossover investors, public market investors piling into private rounds and driving up valuation. So some of these concerns about whether or not private values will assert themselves in public markets are playing themselves out in these two situations.
Meantime, every hour there is a news story breaking in Washington, and so much uncertainty around the future of the administration. Is that impacting any of the folks you're talking to that might be in the pipeline?
So right now, it's not really impacting things. What it is impacting that has an effect on IPOs, obviously, is general equity market sentiment. We're continuing this bull market. Things are still up and to the right, but investors are very uncomfortable. There's not a lot of volatility, yet people are kind of attributing some of that to folks standing on the sidelines because they don't know if major impact policy pieces like tax reform or whether or not repatriation happens. People don't know if those things are going to actually work their way through the system. So if you're a company and you're ready and you didn't get out already, you're probably prepping to go for post-Labor Day in September. And if you're not, then you're looking kind of more at a 2018 listing. If things stay calm as they are now, then it's okay to get that deal out there. But, you know, the big concern points, if economic policy doesn't go through, if there are big kind of other risks in the equities market, that does slow down the pipeline as we saw in about 2016.
All right, Alex Barinka, our Bloomberg News IPO reporter. Alex, thanks so much. I know you will keep us on top of it all. Coming up, we wrap some of the biggest headlines that caught our attention in the week in tech. And if you like Bloomberg News, check us out on the radio. You can listen on the Bloomberg Radio app, Bloomberg.com, and in the U.S. on SiriusXM. This is Bloomberg.
I'm Elisa Parenti in Washington, and you're watching Bloomberg Technology. Let's start with a check of your first word news. President Trump plans to put veteran Washington lawyer Ty Cobb in charge of overseeing the White House's legal and media response to investigations into Russian meddling in the 2016 campaign. According to people familiar with the decision, Cobb is intended to be the enforcer of discipline, public spokesman, and the point person for questions from congressional panels and Justice Department Special Counsel Robert Mueller. Senate Majority Leader Mitch McConnell's latest health care draft almost certainly is headed to rewrite again in order to find a way to appease both sides of the Republican Party. The bill already has drawn 2 firm no's, leaving McConnell unable to lose any more support to get the 50 votes he needs. The chairman of the Freedom Caucus, Republican Congressman Jim Jordan, spoke with Bloomberg today and said he thinks the Senate bill could make it through the House.
I think it has a real chance of passing. I mean, that's what we told the American people we were going to do. I'm always clear. This is not full repeal, which is what we told them. That's why we fought so hard on the House side and had that long debate. And we know conservatives, because of that debate, made it better. But it's still a good step in the right direction.
Jordan also said he was, quote, concerned with some of the taxes still included in the bill. The White House says President Trump spoke by phone aboard Air Force One today with King Salman of Saudi Arabia. Salman congratulated the president on the U.S.-led coalition's victory over Islamic State in Mosul. The leaders are also said to have discussed the diplomatic dispute with Qatar. The UK acknowledged for the first time in writing today that it will have to pay money to the European Union when it withdraws from the bloc, seeking to tamp down on a fight over the country's so-called Brexit bill. Speaking to Bloomberg today, Ireland's finance minister says the EU isn't planning on punishing the UK for Brexit.
There is no intent whatsoever within the European Union to be engaged in a process of punishing the United Kingdom. As a country that has referendums ourselves very frequently in Ireland, we respect the decision of the British people expressed through the referendum, and the European Union recognises that too.
Donahoe also said both sides will engage in a process that will yield a figure at the end of it. Now, the American doctor who specializes in conditions such as the one affecting Charlie Gard will travel to Britain next week to assess the critically ill baby. The 11-month-old suffers from a rare genetic disease that has left him brain damaged and unable to breathe unaided. Gard's parents had been fighting to take him to the U.S. for treatment, but after much legal wrangling, Dr. Michio Hirano of Columbia University has decided to go to them to examine the child. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Elisa Parenti, and this is Bloomberg.
This is Bloomberg Technology. I'm Emily Chang. Let's return to a top story we are watching. Sprint is seeking new investments and reaching out to some of some high-profile names. Chairman Masayoshi Son held talks with billionaires Warren Buffett and John Malone about investing in the wireless company, according to a person familiar with the matter. Shares of Sprint rose 4% in Friday's trading session, spiking after reports at the meeting surfaced, along with details that Buffett could invest as much as $20 billion. We talked about this story along with other big tech stories of the week with our Bloomberg Tech editor, Tom Giles, and Bloomberg Tech reporter, Eric Newcomer. Take a listen.
This is a company that is losing money. It has slipped to 4th place in the rankings of U.S. wireless companies behind T-Mobile. So now it's got Verizon, AT&T, and T-Mobile ahead of it. It has just not gone well. Moss has been looking for a partner, looking for a way to kind of work on Sprint, make it a better investment, find a merger partner. T-Mobile is often mentioned. We see T-Mobile's shares up on this news. This is a way of infusing some capital into the company, giving it some more firepower, and maybe making it a more attractive partner for T-Mobile.
Well, and T-Mobile and Sprint tried to merge once before, and it didn't work out, at least, as far as regulators were concerned.
That's right. But the sense is right now, the Trump administration, we don't think that the Trump administration is going to be real hard on mergers, although the verdict is out on AT&T and Time Warner.
Right. Okay, so let's talk about Snap. Second downgrade in a week.
Yeah.
Snap shares not feeling it.
Right. And underwriters downgrading them. Morgan Stanley and Cohen, I think. And, I mean, yeah, the stock falling to near low. I think it was 15.30 when I looked last. 15.24 being the lowest it hit. So it's well below the $17 IPO price and has really sort of been punished here for,
$15.30 right
Lots
now.
of competition from Facebook. Cowen, in their note, expressed concerns about the monetization efforts that you see at Snap taking longer than expected to pan out. So Snap has been, ever since its IPO, has just been a real storybook of overvalued companies that once they go public, once they get in that white hot light of public scrutiny, not doing so well.
Now, Morgan Stanley earlier this week talked about the fact that the ad products hadn't evolved, that investors were excited about this very intriguing new ad proposition. But Facebook, at the same moment that Snap went public, really stepped up just how aggressive they were being. They have copycatted Snapchat features across all the platforms, whether it's Facebook, Messenger, WhatsApp, Instagram. I was speaking to former Twitter CEO Dick Costolo about this earlier this week. When he was at Twitter, of course, had to contend with Facebook. Take a listen to what he had to say about the prospects of Snap.
I think that Evan will continue to show interesting and maybe fascinating consumer insights that will probably continue to be copied by others. But they're going to have to try to figure out how to outflank somebody, these bigger players like Facebook, on the ad side.
So very positive about Evan Spiegel, but very cautious about competition from Facebook. What do you think?
Yeah, I think Evan had this whole story. We're going to be the product innovators, and we're just going to have to keep updating the app to stay ahead of Facebook, and that clearly hasn't sort of proven true yet. I think we need to see Facebook's just a really good copycat, and they're not too embarrassed to say it. I think it's funny talking about Facebook because obviously their stock price took an even worse beating when they first went public. So there is sort of, this, you come out, you have a lot of shares tied up, and there's anxiety, and your stock price takes a beating. So it's not the first time we've seen it. It worked well for Facebook. It didn't work well for Twitter, and we'll have to see.
So let's talk about Uber. Uber backing out of the Russian market. It's still going to have a stake in this company, but Yandex, the market leader in Russia, which is basically the Google of Russia, essentially has won. Tell us what happened.
Uber is ready for a profitability story, and the losses in Russia compared to China weren't as big. It was like 150 million over 3 years compared to more than 2 billion in China. But still, it wasn't looking like either business was going to be able to turn much of a profit. The index was way ahead. It had like $1 billion in gross bookings run rate compared to Uber's like 500 million. And then Uber got more than a third of the company. So I think Uber sees this as a good opportunity, one, to step away from its losses, two, to have a lot of upside in the Russian market and let a local leader run the business.
Let's talk about the search for the Uber CEO. I know that you have been chasing this. There have been reports, a lot of names thrown out there, other reports. None of those people are actually interested. Some of those people aren't even in the mix. What do we know?
I've been in this super skeptical of the names thrown out camp. I think Nikesh Arora, like Marissa Mayer, those names get thrown around. It doesn't seem like they're truly in the mix. I think, there's a lot. It's fun in Silicon Valley to talk about the tech names. I think it's very likely that we look in like airline industry, like huge operations experience. And, there are a lot of names being thrown out, but, they're going to have to get these 4 search, Travis is involved. He has to sort of like the new person, presumably. So it'll be interesting to see how that process works out.
You want somebody who knows how to deal with operations. You want somebody who can deal with regulators. Again, outside of Silicon Valley, this isn't their bailiwick. TPG, right, brought somebody on to the board who has this background in industries outside of Silicon Valley, outside of the technology industry.
My conversation there with Bloomberg Tech's Tom Giles and Eric Newcomer. Now to a story we've been following, another lawsuit in a wave of allegations about the tech industry's hostility towards women. A former female employee of Better Work Systems sued the startup and 3 executives alleging sexual harassment, physical assault, and a work environment that is hostile to women. The complaint involves inappropriate actions by Better Work CEO Chris Duggan. Kleiner Perkins Caulfield Byers is a major backer of Better Works, and the venture capital firm's chair, John Doerr, sits on the board. Meantime, Doerr is co-authoring a book with Duggan. Better Works and Kleiner Perkins declined to comment. Coming up, game over for DraftKings and FanDuel and their merger. You will hear from DraftKings CEO Jason Robins on the next move for the daily fantasy sports startup. And this weekend on Bloomberg Television, we'll bring you our best interviews from the week, including our wide-ranging conversation with former Twitter CEO Dick Costolo, now CEO of the startup Chorus. Tune in this Saturday for the best of Bloomberg Tech. This is Bloomberg. Troubled startup Juicero says it's cutting 25% of its staff. The company behind the $399 internet-connected juice machine came under scrutiny in April when Bloomberg revealed the packs could be squeezed by hand, yielding almost the same amount of juice in a shorter period of time than with the machine. Job reductions are primarily in sales and marketing. As part of the change in strategy, Juicero's founder and former CEO Doug Evans will no longer be involved in daily operations, but will keep a board seat. Meantime, a game changer in daily fantasy sports. DraftKings and FanDuel called off their merger this week. This coming after opposition to the deal from the FTC. Bloomberg's Scarlett Fu had a chance to talk to DraftKings CEO Jason Robins and asked about the reasons to terminate their plans.
It wasn't an easy decision, but as we looked at our current situation and we looked at the prospects, both in terms of cost, mindshare, resources, and also just likelihood of prevailing with the litigation, we thought that it made sense to move on as separate companies.
You mentioned the costs. How much have you spent on trying to get this merger through? Can you give us a sense of what the final bill might likely be?
Well, so far it's been in the millions, but litigation is the most expensive thing. So had we decided to continue to proceed and seen that all the way through, it would have been far more expensive than what we've spent thus far.
Can you give us a sense of how this decision to terminate the agreement evolved? Was it you who decided it, or was it Nigel Eccles, the CEO of FanDuel, who decided to, or who's the driver behind terminating the agreement?
It was much more of a mutual thing. So it was not even just Nigel and myself. We have a board and investors that weighed in. And, it was certainly a mixed bag. There were some people that were in favor of continuing to try to pursue it. But the overall, I think, not consensus, but general vibe on our end was we all thought it was the best thing eventually to move on. And, in talking to FanDuel, I don't have as much insight into the dynamics of their board or shareholders, but in talking to FanDuel, it sounds like they arrived at a similar place. So, then we just talked about how does this make sense to manage, and, we all decided that we had to continue to run the process in parallel tell in case something changed. So that's why, you mentioned earlier we were filing briefs kind of and pursuing that up until the last minute. But, it was apparent, I think, in the last week or two that both of us wanted to kind of figure out a way to unwind this.
Gotcha. And I ask because you were raising money throughout the merger process, and some would observe that DraftKings was operating as if the merger was no guarantee. You've talked about your financial performance in the statement that you released. What is the key driver in the change in your financial position since the merger was announced initially?
Well, I think there's been two things. One is our business performance has continued to improve. So, we are now growing at almost 40% year over year and climbing up from in the 20s last quarter. So that continues to get better and better, and we're expecting a really big NFL season. I think we're going to have enormous growth and a lot of really exciting promotions and new initiatives on the product front that we'll be launching. And secondly, we were able to bring on some great investment partners in a fundraising process that we ran back in January. So Eldridge Industries, led by Todd Boley, Mark Genender, and their team came in.
Right.
We had investment from some others like Soros that came in. So we're very well capitalized right now. We don't need money and do not need it for the foreseeable future, maybe ever. And that was part of the decision as well. As we looked at our current situation and looking forward, we said, we're in a pretty good spot. We don't really need this merger anymore.
You say you don't need money right now. Both you and FanDuel, as we all know, burned a lot of cash on marketing and advertising when you were independent companies, particularly in 2015. What did you learn from that ad spending war, and how will you adjust your approach going forward now as separate companies?
It's interesting because from a pure performance standpoint, it was a very successful period for us. We gained millions of new customers. We grew substantially. I think that year we grew like 400% or 500%. But unfortunately, it attracted some regulatory attention. I also just think there was burnout in general. We got a lot of feedback from customers that even though it was effective at acquiring new users, there was some that were growing tired of seeing that volume of advertising. So I think we've learned a lot about how to strike the right balance, and you will certainly see increased advertising from us this year and going forward, but nothing at the level that you saw in 2015. I don't think we'll ever go back to that.
Okay. Is there still room for two separate companies in the online daily fantasy sports market, or will one of you need to team up with another partner, say a casino company, a media company?
I believe there's room for more than two. I think this is an enormous market, and it is only going to grow from here. And you're seeing other companies enter the space thinking just the same thing. There's a little bit of a, because of the period where there was some regulatory question, I think there was a little bit of a pause in terms of, interests from other companies coming in. But now you're seeing that reaccelerate again. So I think there's plenty of room for many companies. I will add, though, that for any consumer technology company, particularly one focused on entertainment and trying to earn the dollars that those customers are spending on discretionary things, you have to constantly be innovating, constantly changing. If you look 20, 30 years ago, the companies that are on top of consumer tech today, many of them didn't even exist.
Right.
It is a constantly changing, evolving world. With technology what it is today, that's only going to increase. And we happen to sit at an area, the intersection of sports and media, as well as gaming, which is evolving maybe as fast as anything. So we're going to have to stay nimble. We're going to have to stay innovative. And I think that you're going to see a lot of really interesting new things from us over the coming years.
Bloomberg's Scarlett Fu there talking with DraftKings CEO Jason Robins. Coming up, Game of Thrones is one of the most popular shows on the planet, but can its success help fuel HBO's streaming service? This is Bloomberg.
It's behind me, I think.
In today's revolving door, longtime Amazon exec Mike George is departing the company after nearly 2 decades. As vice president at Amazon, he oversaw the launch of 2 of the company's most popular devices, Alexa and Echo. George confirmed the departure on LinkedIn, saying he's retired from Amazon and loved every minute. He'll be replaced by Tom Taylor, who's been running Amazon Payments and the Fulfillment by Amazon business. Season 7 of Game of Thrones debuts on Sunday. The show has grown into a massive hit for HBO, but has it translated into subscriber growth for its standalone streaming platform, HBO Now? Bloomberg reports almost 3.5 million people have signed up for the service, but it's not growing as fast as some of its other streaming competitors. Paul Sweeney is Director of North American Research for Bloomberg Intelligence and joins us now from New York with more. So, Paul, why?
You know, it's been 3.5 million subscribers is a good number for HBO Now. It's, as many people probably know, HBO Now is one of the first streaming apps to come out of mainstream, kind of media, if you will, to try to compete against the Netflix of the world and the Hulus of the world. So, it's kind of blazing a new trail in terms of how many subscribers would sign up. So 3.5 million is big, but it's obviously nowhere near the likes of some of the other streaming players there. So I think what HBO is finding out is that HBO Now is a viable product within the context of the overall HBO brand. So if there's great programming on HBO viewers want to view it anytime, on any device, anywhere, and HBO Now is just one of the several options that HBO fans have to watch their programming. But as a standalone app, I think some of the growth probably wasn't as much as they thought, at least initially.
Is the content available on HBO Now exactly what's available on regular HBO? Might they consider, some original or exclusive content?
Yeah, they were. Generally, the answer to that is yes, and they were actually going to have a lot of original programming exclusively for HBO Now, but I think they've kind of backed away from that a little bit again, maybe in response to some of the slower growth numbers in terms of the take-up. So now I think they're positioning HBO Now kind of as one piece of the HBO experience, along with live viewing and along with playback that you get with many paid TV operators. So the HBO Now is just kind of the third leg of that stool, if you will, in terms of giving the HBO fans kind of their content wherever they want it, whenever they want it.
I'm watching these scenes of Game of Thrones and getting so excited. It's actually pretty amazing how even in the 7th season, there's still so much anticipation and hype around this series. I mean, does it all come down to having successful original content and having a major hit show?
I think it does. And, HBO has had such a long track record with their original programming, starting with Sex and the City and The Sopranos years ago. They had a little bit of a lull over the last several years, but this Game of Thrones has really reignited the creativity at HBO. And I think that's really given them a lot of, it raised its profile even more with consumers, but also with their pay TV partners, the cable companies, the satellite companies. Those are the companies that really promote and sell HBO to their customer base. And it's a lot easier to promote and upsell HBO to cable subscribers when you've got must-see television like Game of Thrones.
And Netflix is reporting results on Monday. What are you expecting?
Yeah, I think another good quarter coming out of Netflix. The stock is up, 30% year to date, 60% over the last 12 months. So the market continues to discount very strong growth here. And I think the key fundamental issue that investors will be focusing on will be international subscriber growth. That is where the growth for this company is going to come. The U.S. market is fairly well saturated. The growth rates have slowed in terms of new subscribers. So investors have really turned their focus to international growth because that's what's going to drive this company over the next several years in terms of top-line growth.
Now, we've asked time and again if the billions of dollars that Netflix is spending on original content is going to pay off. Do we have any more evidence, that indeed it's been worth it?
Well, I think most investors feel comfortable in the programming investment as long as subscriber growth continues to grow. The long-term off-balance sheet programming liability for Netflix is north of $14 billion now. So how do you pay for that programming liability over time? You continue to grow your subscribers. That grows your revenue. That grows your cash flow, which pays for the programming. So the top line of that pyramid, the top line of that story has to be subscriber growth. And again, the company has kind of pivoted away from the domestic U.S. market and focusing on international growth. And I think as long as that top line growth continues to grow, and as we see some of their newer markets go from loss-leading markets to profit markets, that'll give investors comfort that there is in fact going to be long-term cash flow there to support not only the growth of the company, but to pay these programming liabilities.
All right, Paul Sweeney there with Bloomberg Intelligence. We will be all over Netflix earnings, of course, on Monday. Thank you, Paul. That does it for this edition of Bloomberg Technology. I will be heading to Aspen, Colorado on Monday for the Fortune Brainstorm Tech Conference, speaking to a great lineup of guests, including Marnie Levine, Chief Operating Officer of Instagram. And Bloomberg Tech is live streaming on Twitter. Check us out at Bloomberg Tech TV weekdays, 5 p.m. in New York, 2 p.m. in San Francisco. That's all for now. This is Bloomberg.